Good afternoon, everyone, and welcome to today's knowledge session on alternative investment funds in India, a financial year 2025 review. Over the past few years, alternative investment funds have moved from being a niche allocation to becoming a meaningful pillar of India's investment landscape. FY 2025 in particular has been a defining year, marked by continued growth in commitments and fund launches, evolving investor participation, and a sharper regulatory focus from SEBI. At the same time, the industry has been navigating questions around compliance, valuation, governance, and global capital flows, making this a timely moment to pause and take stock. Today's session is designed to do exactly that. Look back at the key developments that shaped the AIF ecosystem over the past year, unpack emerging trends, and reflect on what lies ahead for fund managers, investors, and the broader market. To help us do this, we have two speakers who bring perspectives from both the legal and operational sides of the AIF ecosystem. We're first joined by Mr. Parth Gala, co-founder and CEO of Navigate AIF. He is a lawyer by training and brings hands-on experience in the AIF space. He, having previously worked with firms such as Khaitan and Gates, his work has focused on fund setup and compliance, giving him a strong view into the structural and regulatory backbone of AIFs. We also have with us Mr. Jugal Bhatia, Head of Finance at Barings Private Equity Partners. Since joining Baring in 2016, Jugal has worked across core financial and regulatory operations and now is heading accounting, compliance, finance, and risk management functions at Baring. His role places him at the center of managing financial and regulatory operations of AIFs, giving him a practical on-the-ground perspective on how funds are structured, monitored, and scaled in today's environment. We look forward to an insightful session with our speakers today. With that, let's dive into the session. Over to you.
Thank you so much, Anushka, for the kind introduction. Thanks, Jugal, for agreeing to do the session with us and giving your valuable inputs on this. What I'll do is that I'll just share my screen, which has the presentation that we have prepared for this session. The idea of, you can see this, right? Yes, perfect. So the idea of today's session is to go through all of the key regulatory amendments, the regulatory tax, RBI, IRDAI, SEBI, the tax amendments that have come in the last financial year pertaining to AIFs. We will go through all of them one by one, discuss them in some detail. And at the end of our session, once that is done, we will open the floor for questioning and any Q&A that any participants have in the last 10 minutes where you can ask us questions. So please do keep your questions reserved until then. If you still have something that you feel is pressing and you want to ask on a particular topic, feel free to ask them in the chat box and we will make sure at the end we will address all questions that are in the chat box. With that, I'll dive right in. This year has been extremely active with SEBI going on a spree of enforcement actions, right, Jugal, as you've seen.
Absolutely.
So there are so many updates that have come in this year, and one of the key years where we've even seen a seismic shift of the industry and SEBI's push towards more accreditation and more institutional investors. So we'll come to all of that. Let's start with the three key amendments that have come in this financial year. So what we'll cover in today's session is going to be just in this financial year, that is after 1st May 2025. So we've seen three amendments to the AIF regulations, 23rd May, 9th September, and 18th November. In the first amendment, what we've seen basically, SEBI has amended it and allowed for migrated VCF framework and KIT certification framework. We'll again come to the details of these when we discuss the circulars one by one. But this was the first amendment. Thereafter, we had one more SEBI amendment, the second amendment regulations, in which co-investment vehicles were launched and angel funds were reclassified as a standalone subcategory under Cat 1 AIFs. And we also had the whole accreditation framework for angel funds coming in. In fact, with that, there has been a key focus on angel funds in this year because angel funds have seen a complete overhaul of how they were operating, how SEBI envisions angel funds to operate, who they're allowed to onboard as investors, what investments they can make. Lot of changes have happened in for co-investments and angel funds both. So these second amendment regulations are actually super important. We'll go into details as we discuss circulars of these as well. The third and again a very interesting amendment that came in this year, again a landmark reform, was the introduction of AI only funds. So accredited investor only funds were introduced by SEBI this year. This is AI only funds where every investor, other than the manager, sponsor, and the directors and employees, is an accredited investor. They also launched a revised LVF threshold. So LVF, that is large value fund. Again, these funds are a subcategory of AI only funds because only accredited investors can invest in LVFs. Their minimum ticket size was reduced from 70 crore to 25 crore, thereby really broadening the investor pool. And a lot of exceptions have been given to them also, and this whole framework has come in. We'll again discuss that also in greater detail. With that, let's dive right into the key SEBI circulars that have come in this year. The first is the extension of the KIT certification timeline. So what is KIT? KIT stands for Key Investment Team Member. So, and maybe Jugal can tell us this in greater detail. Can you just give a basic background of a fund and what role the KIT plays for those who may not know how AIFs operate?
Sure, Parth. So the key investment team, members of an AIF or rather the manager of the AIFs, it's their basically responsibility to ensure that investors' money is invested in the best of the assets. So all the investment and divestment decisions is where they are involved, or it's their responsibility to make sure that the appropriate or the best investments for the investors are being made.
Very true, very true. And previously, before this whole thing came in, SEBI used to have a requirement saying that to be member of the KIT or at least to launch a fund, at least one member of the KIT has to have a certification like an educational qualification, either a CFA, CA, MBA in finance, etc. And another member should have at least 5 years of work experience in the like fund management industry where you manage pool of assets. From that, SEBI had revised this to say that at least one person in the key investment team has to clear an NISM exam.
NISM exam, that's correct.
Yes. And the idea was to professionalize the entire industry. SEBI was, and we've seen this, right, in this whole year.
Yes, I think also the idea was that generally the investment team members are not aware of the regulations and the compliances which an AIF needs to be adhering to.
Correct.
So while these are the fund managers or people responsible for making investments, I think somewhere SEBI thought that it's pertinent that these particular fund managers have a decent knowledge and understanding of the regulations
Very true.
themselves, not their teams. So I think that is where such a requirement was introduced by SEBI for
Correct.
them to have an SM certification.
Very true, very true. And actually, the exam completely focuses on a lot of compliance angle, tax aspects, waterfall, everything under the sun for AIFs. What happened this year actually was that the exam was broken down into two certifications. Previously, it was 19C, which had everything category 1, 2, 3, all AIFs. Now, SEBI broke it down into category 19D and E. And 19D basically is for category 1 and 2 AIFs, and E is for category 3, thereby making it more easier at least for people and more focused on exactly what their fund did. So the requirement was that at least one member in the KIT had to obtain this, and the timeline, the deadline to complete this KIT certification was extended to July this year. That's why this was the first circular that came in. The next important circular that we see was the VCF additional liquidation period extension. So as we have seen in this year, a majority of the enforcement action from SEBI towards AIFs has been towards the tenure limits. Like AIFs have a specified tenure, and this was in the previous regulation also. So before AIFs came in, there was a VCF regulations, and venture capital funds used to exist under the VCF regulation 1996. They also had to specify a specific tenure for which they would operate. And beyond the tenure, they couldn't continue. They also had a specific timeline. But still, VCFs were having a lot of assets that were unliquidated, maybe due to litigation, or they felt like their market is not giving them very good value for a range of reasons why they were not able to liquidate all their assets. So they were told to migrate to the AIF regime, and those with unliquidated investments in expired scheme needed additional time. So they needed additional time. They had to migrate to the AIF regime. These were called migrated VCFs. And the additional liquidation period for VCFs migrating to AIF regulation was extended from 19 July 2025 to 19 July 2026. That is 19 July of this year, 26, giving migrated VCFs one extra full year to wind up legacy portfolio investments. And the deadline to file migration applications to SEBI under AIF regulations remains fixed at 19 July 2025. Only the additional liquidation period that these funds had to migrate and to sell, liquidate all their assets was extended. And these VCFs that did not apply for migration by 19 July 2025 faced the SEBI enforcement action. In fact, SEBI also launched the VCF settlement scheme 2025, which was subsequently simultaneously launched to address legacy violations. So we also saw the introduction of VCF settlement scheme. In fact, just last week, we even saw the settlement order coming from SEBI, where more than 29 VCFs had to settle with SEBI, and we will come into that settlement scheme also. We'll come and discuss the settlement scheme also that was introduced by SEBI for VCFs. So the pain point that is there for all of these VCF funds is that they were not able to wind up within the prescribed tenure in the PPM. That is the key pain point. So who is the VCF settlement scheme for? It was for legacy venture capital funds that migrated to the AIF regime. That is, they applied for migration by 19 July 2025, but still held unliquidated investments in schemes whose tenure had expired. So they had to apply the application window from 21st July to 19 January, and they had to file applications and pay the prescribed settlement fees within this window to avail of this scheme. So they had to pay the settlement fees also. The settlement fees that they had to pay is actually ranging from 25,000 rupees plus 18% GST is the non-refundable application amount, plus 1 lakh rupees for delay up to 1 year, and 50,000 for each additional year of delay. The fee graduated by duration of non-compliance. So we have actually seen in the order that came in, the fees is ranging from 50,000, about 2 lakh rupees I saw in the minimum, to 9.5 lakh rupees. That is what the funds had to pay, and this is how it was calculated. The benefit of settling was that SEBI had settled under the scheme. Whoever settled under the scheme had to got to avoid the SEBI adjudication and enforcement proceedings for the violations that are covered, and the settlement provided regulatory closure for legacy compliance issues. So in fact, we've seen a lot of regulatory action on this specific issue, that is on unliquid investments at the end of the tenure. Initially in 25, SEBI had even launched a liquidation scheme option. Thereafter, currently, the framework provides a dissolution period. So now I'll give the current regulatory framework what it says. The current regulatory framework is that after an AIF's tenure is over, from the date it's over, first you have a 1 year liquidation period under the regulations itself. This 1 year liquidation period, you have to try and sell all your assets. After that is done, you can, and within that period, if you feel like you're not able to sell your assets, you can give the investors two options. You can give them an option to go into dissolution period, which again needs 75% consent, or you can give them an option to do in specie distribution of their assets. So they can do this in specie distribution or go into dissolution period. If they choose to go into dissolution period, you want to do that. In that case, you have to file an information memorandum with SEBI, and actually you get extra time when you can liquidate the investments. In the dissolution period, the only role of the fund will be to liquidate the investments. And whoever did not settle with SEBI under the scheme was subject to SEBI adjudication and enforcement proceedings. That was the idea of the VCF settlement scheme. So yes, that is on VCF settlement scheme. The next and very interesting point is the co-investment vehicle scheme framework. So Jugal, why don't you give us an idea into what is co-investment and what the idea behind this is?
Sure, Parth. So just to give a brief on what co-investment actually means is, co-investment is when the fund is making an investment, and sometimes you might have some LPs who are, willing to top up on a particular type of portfolio company or a particular sector depending on their risk appetite. Because you as a manager are already familiar with that portfolio company and the operations and that industry sector. You've already done a risk assessment on those. And sometimes when you fund these companies, keep on funding, while the company is growing, expanding in the initial years, they might need additional capital for working capital or growth or expansion, etc. And maybe the AIF might or might not have that much of a risk appetite in a particular company.
Right.
So that is where the co-investment typically comes on as a
Correct.
follow-on, or where the manager introduces their LPs, their marquee LPs, to these portfolio companies where they can put some monies or investments. So now I think SEBI saw that this could be a potential conflict or a potential issue whereby I think the rights of the main fund, the investors of the main fund, should not be compromised in any case.
Right.
So I think that is where SEBI came up I think earlier, a couple of years back, with the licensing requirement of the co-investments.
Very true. Yes.
And I think in September 2025, SEBI came up with these CIV investment scheme to
Correct.
facilitate the co-investment for the investors of the AIF, to have a framework whereby investors could participate, and because otherwise the manager would have to take a separate license. The only difference I feel between these two schemes is, in the earlier, the PMS licensing scheme, I think it's very discretionary and on the investor.
Right.
Here, that discretion is there to a very slim extent.
Right. Very true. So that is very, very interesting. So currently also SEBI has continued the CPMS license. SEBI is still
Correct.
giving the option. The only another challenge was that the CPMS, so there are two options to do co-investment. One is the investment manager can get a CPMS license. CPMS stands for co-investment PMS license. This is a separate license they can get registered with SEBI. Under this license, they can offer co-investment opportunities to their investors in the AIF. But there are some key rules for offering co-investment. One of the rules is that the co-investment deal has to be co-terminus with the deal that the AIF does. So basically, the co-investor, it can't be that you sell the AIF investment to the co-investor by virtue of a co-investment deal, or you give entry to the co-investor but let them exit early, and then the AIF is still invested in the company, or you make them exit later and make the AIF exit earlier. None of that. The entry and exit of the co-investor and the AIF has to be same at the same time. The only challenge was that CPMS was a little bit expensive. 15 lakh rupees was the PMS licensing fee, and then every 3 years had to renew at 5 lakhs. Now SEBI said that what you can do is you can just launch a new scheme under the same AIF license, which would cost 1 lakh rupees that it costs to launch a scheme. And this scheme would get its own PAN card, and that scheme would make only one investment, which would be in that investee company. And then for each deal where you're offering co-investment, you launch new co-investment schemes, and you offer this co-investment opportunity. Now, the way to do this is that you have to launch a shelf PPM. You have to create a shelf PPM, submit it with SEBI. And SEBI even gave a very detailed framework of what the shelf PPM would look like, what all terms you have to disclose in this. But one thing which is very interesting, which is only there in the co-investment vehicle, not there in the CPMS, was that SEBI restricted this participation in CIV to only accredited investors. So SEBI has said that only accredited investors can participate in CIV scheme, but co-invest and PMS is open for all kinds of investors. So that was one of the first key areas where we saw accreditation come in, and SEBI really pushing for this, where they gave a benefit essentially to accredited investors of giving them the chance to participate in CIV schemes. And CIV scheme is a separate scheme from the main AIF scheme, but registered within the same entity. One drawback that I actually got from the market when I was talking to managers, asking them whether they're doing CIV schemes, is that in the CIV scheme, the investment is restricted to 3x of what the exposure is.
Correct, that's true. So I think SEBI might not have wanted a scenario where, investor is, on the overall fund, while they have a very small concentration or small exposure, but in select schemes, they are pumping in more money. So they had to create some kind of a overall restriction that,
Very true, yes.
Otherwise it defeats the purpose of the investor. You'll have a 1 crore, an investor committing 1 crore to the main fund, but investing 10 crores or significant amounts via the co-investment scheme.
Correct. That is true. And that is one key point you have to remember also when you launch co-investment schemes on the restrictions there. Another thing is on expense sharing and compliance. The expenses must be shared proportionately between the main AIF scheme and CIV scheme based on the investment size and as agreed in the fund documents. The compliance test report must again confirm adherence of the circular, and all disclosure related to co-investment term must be made in the PPM of the main scheme prior to launching a CIV scheme. So make sure that when you're updating the PPM this year, you're even mentioning relevant disclosures relating to co-investment terms. As we go into this revised regulatory framework for angel funds, before this, I just want to touch upon one more key regulatory framework that we've seen come in, which is the digital accessibility compliance. Again, that came in July of this year, July 2025. This is also something that is applicable on all AIFs, all SEBI-regulated intermediaries, where they have to basically get their digital platforms audited by an IAAP certified auditor. And there are a list of requirements SEBI has given. So now The background to this is that there was a judgment of the Supreme Court in the Pragya Prasoon versus Union of India matter. This is a key judgment in Indian history where basically digital accessibility has been made a fundamental right under the Constitution under Article 19. And the court has said that every regulated entity, whether you're regulated by RBI, SEBI, TRAI, telecom regulator, or IRDA, insurance regulator, your digital platforms have to be accessible for person with disability. So essentially, a blind, partially blind person or person with mobility issues, any person with disability should be able to access it. And you have to ensure this compliance is done. Even the investor charter in the PPM has to mention a digital accessibility clause, and that is also something SEBI has mandated. So we've seen that. That is another key compliance we saw. Coming back to the regulatory framework for angel funds, right? So this year has seen a full overhaul of angel funds, and I have actually witnessed this firsthand because at Navigate AIF we help funds with accreditation, and some of our biggest clients are angel funds only because they have to get all of their investors accredited, and these are funds with thousands of investors, so they have to get all of them accredited. And the idea is that the reason why this is being pushed so much is that SEBI has said that for all new angel funds that are registered after 10 September, they can only onboard accredited investors. And for existing angel funds, they have time till 8 September 2026, after which they will not be allowed to onboard any non-accredited investors. And in this transition period, in this glide path, the period till 8 September 2026, they can only onboard 200 non-accredited investors. So there's a very strict requirement that has been pushed on them to onboard only accredited investors, and after 8 September, essentially they are going to be restricted to only accredited investors. And we have seen in this year the massive drive. Like I'll give you data also on this. Before June 2025, across India, I think there were only 640 accredited investors, and since then we have seen that number almost triple, and a lot of investors are getting accredited. The other changes for angel funds is that the minimum investment amount has been reduced from 25 lakhs in a portfolio company to 10 lakhs, thereby increasing the base. And the maximum investment amount in a portfolio company has been increased from 10 crore to 25 crore. The minimum corpus requirement for an angel fund has been fully removed, and any accredited investor that signs up to the angel fund can commit any amount. There's no minimum 25 lakh or any amount that they have to commit. They can practically commit any amount. There's no minimum investment amount also. There's an introduction of an annual PPM compliance audit for angel funds, wherein all those angel funds whose aggregate investments exceed 100 crore, they have to conduct a PPM audit. And this was a key compliance that has come in this financial year for angel funds. Other key changes that we have seen is performance benchmarking has been made mandatory for them. So angel funds have to comply with SEBI's performance benchmarking framework. There's a mandatory submission of valuation data and cash flow information to SEBI empaneled benchmarking agencies. This actually enables peer level performance comparison for the first time in the angel space. So performance benchmarking is something very interesting. The idea is that for alternatives, there is no benchmark. So if say I'm running a Cat 3 fund, then I can have maybe the Nifty or Sensex, Nifty 50, small cap index, something as that as a benchmark, because I know my investment is also in similar companies. But in alternatives, you need to have a benchmark. So with that idea, SEBI has mandated that every fund, yes, what are your thoughts, Jugal, on benchmarking, and how have you seen this evolve?
So I think both the points that you covered here, Parth, benchmarking as well as PPM audit, I think SEBI is just trying to align the angel fund regime with the AIFs, because the
Absolutely.
AIFs have had these benchmarking as well as PPM audit requirement for quite some years. I think at least 5-6 years now for
Correct.
both these regulations. So I think that is where SEBI is trying to, though angel funds is separate, a minimum investment is separate, but the intent of SEBI is to align, the
Very
way
true.
the compliances are getting done and the way their returns are being monitored. So I
Correct.
think that is why
Very
there's a
true,
step
actually.
in that direction.
So while SEBI has done that, I think the SEBI is also going to do one thing where they're going to make. So this is something SEBI disclosed in its board meeting on 18 June, where they've said that while now for angel funds, we have only accredited investors that are allowed, even for AIFs in the long run, maybe we'll see this 3-5 years down the line, even for AIFs, SEBI wants to make it accredited only. And that time what we might see is a rationalization across the industry, across all categories, where at least the investor type is the same, and then you have differentiation in the product from where you're investing, and maybe a compliance also will be something very streamlined, because SEBI can have a one size fits all instead of having so many different compliance requirements. So very true. Like the PPM audit and benchmarking is something that has been streamlined with what is there for CAT 1, 2, and 3 AIFs, correctly said. Transition and compliance, all new requirements apply immediately to new schemes, and existing schemes have to comply within the timelines. There's also a requirement for an allocation methodology disclosure. So angel funds have to actually disclose how they will allocate investments. This is very important. One key difference actually that you would know, of course, is that in angel funds, for each deal, they have to ask for investor consent. It's not a blind pool like a cat 2, where they can just, the manager has a discretion to invest money, or angel funds seek consent for each deal. And this, they had to actually give a allocation methodology in the PPM on how they will allocate these yields to investors. This also was extended, the timeline was extended from 10th October till 31st January 2026, that angel funds had to disclose a methodology for extension for allocation of investments. And once the PPM disclosure is completed within the extended timeline, all subsequent investments must strictly adhere to the disclosed allocation methodology only, and no discretionary departure from this methodology is permitted after the disclosure. So then you have to maintain that you will follow this methodology. Modalities of migration to AI only schemes and LVF. So this is actually very interesting. In fact, after this was released, I remember I got so many calls. Some clients who are now actively considering AI only schemes and LVFs. And Jugal, why don't you give us some idea into what the LVF regime is and what do you see this?
So I think LVF regime was again introduced by SEBI basically to have larger investor or investor with deep pockets, larger ticket sized, a fund regime or a fund scheme for them, which had fewer restrictions and regulations on them. And if I correct me if I'm wrong, Parth, I think
Yes.
earlier that limit was 70 crore, which has
Very
then
true.
been reduced to 25 crores.
Correct. That's right. Yes.
So I think that was
That
the-
is actually very good.
That's right.
Because 70 crore was very, like, it was difficult for funds to raise, and then we would kind of seeing very big foreign institutional LPs having LVS, but not a mass adoption of the product. So I think to make it a mass product, SEBI thought that, I don't think mass, but in the sense that at least to cater to more HNIs and ultra HNIs, a 25 CR is a more reasonable number where they can seek that consent. And this is a very key thing. We will even be able to analyze this data actually. And one thing I would like to add here is one confusion a lot of people have. They think LVF is a type of AIF. LVF is just a scheme. So I can have a CAT 2 license and launch an LVF and a normal fund.
That's correct.
What SEBI has now mandated, very interestingly, is that every LVF and AI only fund has to have the name saying LVF in the name or AI only fund in the name. See, I've even mentioned it here. The scheme name must incorporate AI only fund or LVF. And for those who are migrating, because a lot of funds now are considering that we will migrate to the LVF regime, they have to get consent from all their existing investors before migrating. There are some exemption if you are an LVF. One is that you don't have a standard PPM template. Because you don't have a standard template, you don't need a merchant banking like a DD certificate also to apply to SEBI. That becomes an exemption for them. They have to not even do annual PPM audit. That is again a good exemption. So without needing individual investor waivers. Previously, they were required to get a waiver from investors to do PPM audit. Now, SEBI has revised this to say without getting individual investor waivers, they can do they can waive the annual PPM audit requirement. Another benefit was an IC member exemption. So members of the IC investment committee of the fund are not responsible for the decisions complying with Regulation 20, Sub-Regulation 3. So it reduces a lot of fiduciary responsibility on the IC members, reduces risk on them, and the best actually benefit to them is that concentration limits are doubled for them. So they can actually invest 50% in CAT 1 and 2 LVFs and 50% of investable funds per investee company. And CAT 3 LVFs can invest 20% of investable funds per investee company. So these are all for LVFs. For AI only funds, we have even more benefits. So what are benefits are there for AI only funds are automatically there for all LVFs. So these are additional benefits that are given to them. One, and this is very interesting, accredited investors are excluded from the 1,000 investor cap per AIF scheme. Now this is applicable for all funds. For all funds, when you're computing the 1,000 investor cap, you can exclude or accredited investors from it. So you can check. In fact, on this, I will add one more very interesting thing. I was recently reading the revised annual activity reporting format that SEBI has released. In that, SEBI has asked funds to disclose how many investors are accredited and how many are not. And you have to give how much funds have you raised from them, commitments from them, received from them, etc. from accredited investors. Now, this is also going to be interesting. Funds have to figure out which of their LPs are accredited and ask them. And again, if some funds are closer to 1,000 investors, they can even exclude them. And maybe we'll have funds in India that cross 1,000 investors also. I don't think anybody's reached there yet, but yes, maybe we'll see that. Um, then other benefit to AI only funds is NISM certification exemption. This is great. If the management finds out they will want to launch an AI only fund, they don't have to give the NISM exam then. Extension of tenure has been given. This is again linking back to what we discussed, the enforcement action previously. That once the tenure is over, AIF regulations currently permit a 2-year extension with 66% investor consent, or 2/3 investor consent. Now this can be extended for up to 5 years, including all the extensions granted before conversion of AIOF status. So they can actually extend the tenure also. Another very helpful requirement, very helpful benefit that they've given them is exemption from pro rata and pari passu rights. So SEBI has mandated in a circular dated 13 December 2024, where you have to maintain pro rata and pari passu rights of all aspects of your investors. Now this has been exempted. Managers may offer differential rights to different investor classes. And lastly, the trustee obligations. So obligations of a trustee shall be carried out by the manager of the AI only funds under the Regulation 20, Sub-Regulation 24. And this eliminates the need for a separate trustee governance framework. So this is very interesting, and a lot of benefits actually have been given to the AI only funds. We'll see a lot of these being launched. A way to find out if it's an AI only fund is it will be there in the name. So you can definitely see that. Next thing, something I'm sure Jugal may impact you personally is the exam, the NISM exam that has been introduced now for compliance officers also. So what are your thoughts on that? Why don't you share this?
Yeah, so I think as we discussed earlier, the NISM exam was earlier introduced for the key investment team members of the manager. I think this year they've extended it to the compliance officer or the finance or the compliance function of the fund as well. So, but I think, yeah, as rightfully mentioned, the deadline or the effective date for meeting that or clearing that exam is January 2027. So funds are working on it, preparing for it.
Right.
But I think it'll be good if SEBI considers to come up with a new module the way they did for
NISM 19D
yeah,
and E.
yeah,
Yes.
where they created separate for CAT 1, 2, 3, etc.
Correct.
If they could do that for
NISM also. Agreed.
for the compliance officer's exam,
Yes.
that'll be a step in the right direction. I guess.
Actually, in fact, as we were discussing previously, right, the current exam 3C is for all funds that are regulated under SEBI. So it actually covers REITs, that is real estate investment trusts, InvITs, infrastructure investment trusts, mutual funds, every pooled vehicle that you can possibly register under SEBI is in this. I remember when I saw the curriculum, it reminded me of my securities law paper in college, and it has everything. It has inside trading, PFUTP. So basically, very broad, good in a way, but I think that's a good point wherein SEBI can consider it limiting it to AIFs, and then the relevant regulatory frameworks that like inside trading, PFUTP, etc. can be there because that applies to AIFs also, but they can maybe remove mutual funds and other things. Therefore, that for those compliance folks who are fully focused on AIF, a lot of the people who are watching this video may be compliance officers. So a deadline for you coming up is 1st January 2027. Please make sure you give exam after that. Only certified individuals can be appointed as or can continue to act as compliance officers of the AIF after this deadline. And this applies to all categories of AIFs, including managers of AI only funds and LVFs. New appointments of compliance officers after 1st January 2027 require the certification as a mandatory precondition to appointment. So this is that there's no carve out based on fund category, etc. Everybody has to give this. This is called the NISM 3C. The certification is called NISM 3C. Next important change that came in was a simplification of accreditation requirements for AIF investors. So accreditation has been discussed significantly in this webinar also. We have seen a lot of changes relating to accreditation come in. One thing SEBI has done is SEBI has simplified the accreditation requirements. So here what they did is first the AIFs can now execute contribution agreements with prospective investors and even do KYC DD of investors before the investor has shown them the accreditation certificate. So the requirement here is the investor has to obtain an accreditation, like has to at least apply for an accreditation certificate. And if they're waiting for the certificate to be granted, in the meanwhile, the AIF managers can onboard them. So they don't have to wait for onboarding till receiving the certificate. They can onboard them before. The idea was to make the process faster and help funds that want to onboard investors who are still receiving accreditation certificate. One key requirement here is while they can onboard the investor, that is, they can make them sign contribution agreement, they can only draw down or receive funds from such investors after they have received the formal accreditation certificate. This preserves the integrity of the accreditation mandate. And an important change that came in the circular was that net worth certificate was simplified. So previously, as a requirement took a very detailed breakdown of net worth. You have to write what assets you have. This much is in XYZ asset, financial assets, tangible assets, real estate, etc. Now they are saying you can remove this and you can give a simple net worth certificate. Maybe if I'm meeting the criteria, I can say Parth Gala meets the accreditation criteria and has net worth above 7.5 crore and financial assets above 3.75 crore. So just that much we can write instead of giving an exact amount of what the net worth is. And that was something that a lot of investors also requested, that we don't want to give our exact net worth. We just want to give a simplified certificate that has been allowed by SEBI. Now,
So
yes.
on this accreditation or the simplification of accreditation requirements, how easy is it now to get an accreditation certificate? And what were the timelines? Is there any improvement in timeline and the processes for the investors to actually have this certificate with them?
Yes, absolutely. Like at Navigate AF only, we have facilitated more than 300 accreditations. We are seeing timelines of same day. Practically, if investors apply with us same day, we give them accreditation certificate. We have actually automated the process, that is why. But I do think there's been significant simplification that has come in the norms.
Okay.
And because now, if you look at the data, right, if you look at the tax data, there are more than 8 lakh people in India that could get accredited, like as per income tax returns, data on who has the net worth. So SEBI needs to make the process very simple and straightforward. And even in IBCA, in fact, the SEBI chairman said that we want to push accreditation a lot and we want to get people to become accredited. So they have done very good work on this and commendable work by SEBI and the accreditation agencies. And even like we've tried to help players like us, other players who are helping these folks to automate the process, simplify it, make it more helpful. That has made this very fast. In fact, after the this circular came, I even critiqued it, saying that it's not needed because what will you do executing the contribution agreement? We'll give you certificate in the same day. So that can be done. And we are seeing a lot of foreign investors also get accredited in India and who are interested in participating. So absolutely something coming in. This is an interesting one. This is an upcoming deadline for everybody watching. Please note this down if you haven't already. AIFs have to now report their NAV to the depositories at the ISIN level. The deadline for this is 1st May 2026 or within 30 days of the valuation date, whichever is later. This has to be done through their RTAs. For subsequent valuations, NAV must be reported within 30 days from each valuation date. So what are your thoughts, sir? And have you started doing this already, or like I think by 1st May you will also start doing this, right?
Yes, Parth. So I think we are looking at it.
Yes.
Not a very great circular. I think SEBI is trying to have a transparency for the investors, but they're kind of trying to equate this with a mutual fund, and
Very true.
AIFs typically are a more sophisticated product than a mutual fund,
Correct.
locked in product, etc. So
I think an interesting thing that I was thinking of here, there was an amendment in the Companies Act also, wherein every company had to demat their shares,
that's correct.
except small companies. So we have now seen this massive push at an India level, where whatever financial investments you're having, financial securities you're holding, have to be in demat form. So SEBI and essentially the government wants the value also to be here, which till date was kind of in SHA agreements and maybe stamp duty, they would find out the value. Otherwise, they would not come to know the value of these transactions.
Right.
So you might see the entire alternates industry and every unlisted product coming on the depositories, government also getting visibility on the NAVs, and a lot of change happening here actually at the country level.
Correct.
Yes, so this also is in that there are of course a lot of questions on how this will be done, and people are figuring out. But yes, an interesting change, and we may see a lot of clarification also coming from SEBI on this exact.
Yes, there are certain issues I believe which needs to be clarified, same institutional investors having some excuse provision would be having the same ISIN. So how will the NAV work for those?
Right.
What about some defaulting contributors or defaulting investors
Correct.
vis-a-vis non-defaulting having the same ISINs?
Right.
How will the NAV working or the reporting differ for those investors? So on and so forth.
Very true.
There are practical issues around this.
Actually, yes, and
circular.
remains to see what SEBI does on this. The next is a complete overhaul again of the regulatory reporting. So the main and key regulatory reporting that SEBI had for AIFs was the quarterly activity report that will be submitted every quarter within 15 days of the end of the quarter. SEBI has said that now they will simplify this quarterly activity report, and instead of a long quarterly activity report, there are practically just three things that are saying. You are talking about what investments you have made and who you've raised from, and just basic details of the fund. So basic details of the investors, like how much commitments, number of investors, how much is the fund raised, where investments have been deployed. So it's become very simple, 4-pager essentially quarterly activity report. And this quarterly activity report filing will happen from quarter ending June 26. We'll see it that time. The formats are also available on IBCA websites. And a new compliance that SEBI has added is this annual activity report that every year has to be done within 30 days of end of financial year. So by 30th April. But for this year, that is for 2026, SEBI has said that it will be done by 31st of May. So 2 months have been given for the first year. Thereafter, every year you will have only 30 days. And this actually is a massive compliance exercise because SEBI has added a lot of things in this, including things like uh, how many portfolio companies have been dematted, details of accredited investors have been asked. I've done a detailed study of this whole thing and put out the annual activity report and even highlighted which clauses have been added. But any thoughts that you want to share on this also, the annual activity report compliance?
So I think it's the quarterly report getting slimmer and giving simpler data and fewer data points to SEBI is of course a nice step, a step in a right direction, welcoming I would say, and I think rightfully so. While the CTR and the PPM amendment needs to be filed by 30th April, which is 30 calendar days from the end of the financial year. I think that is when SEBI wants us to have a complete annual overview of our other compliances and report it in one go to SEBI rather than
Very true.
having 4 separate. That's also the timeline for the CTR. So
Correct.
that is the time when naturally the compliances are being reviewed, etc., and reported to trustees, etc. While at the same time they just don't want the managers to be very lax, so they've kept some kind of reporting going on, continued quarterly.
Very true. Very true. No, good point. There were also a range of consultation papers that were released in this year. So we saw the one on 9th May on co-investment within the AIF structure. This consultation paper resulted in the second amendment regulations and the CIB circular that came in September 2025. Then we saw a consultation paper on flexibilities in accreditation framework. This led to the simplified accreditation circular in Jan 2026. We saw LVF relaxations come in as a consultation paper, again resulting in a amendment in the AIF regulations and December 2025 LVF circular. We saw another consultation paper on a separate AIF scheme for accredited investors only, that is the AI only funds. This also came in as an amendment. We saw consultation paper on NAV of AIF units to depositories. Again, a SEBI circular was passed on this. 3 consultation papers where we haven't seen SEBI circulars yet, which we may see now, are one, pro rata rights of AIF investors. So SEBI has proposed clarifications on maintaining pro rata pari passu rights of investors. So this has been introduced. We are yet to see a SEBI circular or an AIF regulation amendment on this. AI winding up and surrendering registration. SEBI has given flexibility in winding up schemes, surrendering SEBI registration. SEBI has even spoken about in that same how to deal with unliquidated investments after the tenure. And last is the social impact fund minimum investment review. This is reviewing minimum investment threshold for individual investors and social impact funds. So all of this came in, as consultation papers this year. On SEBI compliance, additionally, we also saw some technical clarifications and extension of deadline of cybersecurity that had come in. And other than that, the digital accessibility thing we already spoke about. So this was just a broad overview. There, of course, smaller SEBI amendments and circulars that came in, which are not covered here. We've tried to look at it more broadly. We'll talk about some RBI and IRDAI circulars also that came in this year. We saw the release of draft directions in on May 2025 to revise the investment norms for RBI regulated entities in AIFs targeting evergreening or stress loans via AIF structures. The final directions were notified on 29 July following a public consultation. So, what have you seen in this, Jugal, and I'll also like to explain the directions that came in from RBI on this.
Sure, Parth. So, I think RBI wanted to stop the evergreening of investments that was happening, which is in a way, for lack of better word, round tripping of
Very
monies from the banks to the portfolio companies. So that is exactly what they wanted to stop, and that is what they achieved. But I think while doing that, some genuine transactions were also hampered and impacted.
Right.
So I think then they amended it to say that even if you guys are doing this, if NBFCs, banks are doing these kind of investments, you might need to make 100% provision
Very
against
true.
such investments.
Correct. The 100% provisioning requirement was added.
Also, I think when they need to have a look through for such portfolio entities, which creates that they should collect all the information from the managers, etc., on their portfolio companies.
Correct. Very true.
To have this.
Absolutely. And this actually, see, the industry impact is also massive. Significant structural
Absolutely.
implications for AIFs with banks and NBFC investors, which are very large domestic LPs in India. So they had to all review and potentially restructure their fund to ensure compliance with these directions. This was a massive change, heavily discussed in the industry, and
Correct.
a lot of compliance work on this in this financial year. We also saw an IRDAI circular on insurer investment. So insurers are allowed to invest in India. The IRDAI permitted insurance companies to invest. So these are life, general, and health insurance companies to invest in AT1, so additional tier 1 bonds and tier 2 capital instruments issued by RBI regulated entities and routed through AIFs. So the routing through AIFs actually provides insurers with professional fund management, diversification, and structural protections. There are a lot of conditions that are specified on this, such as the limits as a percentage of investable funds, minimum credit rating, and detailed requirements. And this actually opened a new institutional investor class, which are insurance companies for credit focused Cat 2 AIFs. So a new institutional class also opened up, and we've seen a growth of credit AIFs, of course, because of this. So I've gone into the details of the circular also here, which have come in, and the clarifications that came in. So they clarified that existing IRDA investments made through AIs following industry queries after, so it interpreted the existing IRDA investment, it clarified the exposure limit, look through risk assessment, and a lot of things relating to IRDA. So you can look at the circular that came in from them as well if you have any insurer on your cap table. Let's also look at 2-3 key orders that we saw coming in this year, which the industry has discussed. A very important and pretty interesting order is on Equity Intelligence AIF Trust versus CBDT. Again, I'll let you take this one, Jugal, on this order and trust structures.
So yeah, Parth. Basically, this was I think a Cat 3 AIF,
Yes.
and unlike Cat 1 and Cat 2 AIFs, which have a very clear black and white distinction for their taxation, which is look through or a pass through taxation, and the income is exempt in the hands of the investors. I think Cat 3 AIFs typically rely on them being a determinate trust,
Very true.
and thereby being taxed in the hands of its beneficiaries in the same and like manner. So I think in this particular case, the AO or
Yeah.
these guys took it as it was indeterminate
Very-
trust
Yeah.
because they I think they concluded it was indeterminate only based on the fact that the names of all the investors were not mentioned
In the trust deed.
original trust deed. But
Right.
I think this is a very good ruling by the relevant courts,
Yes.
honorable courts, and which says that in case there are other documents, legal documents like PPM, etc., and other filings, they determine in any way the share of investors, then you may not deem it to be an
Very true.
indeterminate trust, and hence
Correct.
the benefit of you can't have a double taxation kind of a scenario, or
Correct.
there's no need for it to be considered as indeterminate
Yes.
and thereby tax it
Tax at
at
MMR.
Yeah.
Yes. So the taxation was clarified. This is very critical for the entire industry, especially Cat 3 funds, because we needed to classify and maintain the status of determinacy for Cat 3 funds. This ruling does that. So do read this very key ruling that came in this year. And the last, and again, a hotly discussed ruling in the entire industry is the Tiger Global case. So again, Jugal, I'll let you touch upon this as well. I'm sure you studied this a lot.
Yeah,
Yes.
definitely. So Tiger Global, I think the case was the entity which was subject to tax held its holding in Flipkart, the shares of Flipkart in India through an SPV in Singapore. So it was a SPV in Singapore, or I think an FVCI,
Right.
which held for the shares in Flipkart India.
Correct.
So while selling the shares, they didn't actually sell the shares of Flipkart India. They sold the shares of the SPV, or it was entire SPV being sold
Right.
to the buyer. In which case, I think the courts here, the Apex Court has denied DTAA benefits.
Exactly.
And they've said that the fact that Tiger Global had TRC and 10F are not sufficient conditions.
Absolutely.
We need to look at where the decision was being
The
taken,
substance
the
requirement.
substance
Yes.
and the control, where exactly the decision were being taken.
Correct. The factual scenario also in this case was that there was a US resident, who was actually controlling the fund in Mauritius, and they were trying to take advantage of the India Mauritius DTA, which the Supreme Court denied to them because the control was in the hands of a US resident. So the New York office essentially of Tiger Global, and that was not permitted. So this actually set a very key precedent in India on how we will consider DTA benefits, how like substantive mention, making sure that your foreign investors are able to prove substance and residence in the country where they're seeking DTA benefits, and aligning that to ensure the tax treatment is official, and again preventing like tax avoidance, fund structuring. Courts are willing to enforce this, and we've seen that courts are not just saying relying on 10F and TRC, but actually enforcing the substance requirement there. So with that, we will conclude this and we'll take any questions that people have. So I'll just take a look at the questions. Yes.
Can take that up. So the first question was, what about a disability certificate, whether mandatory, even when no digital platform for investors?
Yes, so if there are no digital platforms for investors, or no digital platforms that it's not just for investors, it's about like any digital platform that the RE has, because SEBI has mentioned that. So in that case, if there are no digital platforms, they won't have to conduct the audit, of course, because they don't have any platform to conduct the audit on. But we still recommend other compliance, internal compliance changes to be done, like relevant changes to the PPM, ensuring that training is done as required under the circular. All the other relevant compliances, appointing nodal officer for accessibility, giving a grievance redressal mechanism that is accessible, all of that can be done. So
Also, Parth, if you could clarify, I think it would help. Would having a website, non-interactive website, there's no login where the investor could log in and see their statements, etc. Would that classify as a digital platform, and do you need to get a digital accessibility audit done?
right, that is interesting. A lot of people ask me this question this year. So our view at least is that that website is covered. That would also classify as a digital platform, because the Supreme Court order or the SEBI circular doesn't give any carve outs for a non-interactive website or even a other website. So they are covering everything. So therefore, we are also taking a look that even a non-interactive website, even if it's a one pager, it is covered. Yes, so that's essentially the idea. It would be covered in the digital platforms.
Thank you, Parth.
Thank you. Yes, Anushka. Next question.
So, there's another question by Ayush. In co-investment provisions, there is a mention that provided that an angel fund shall not launch a co-investment scheme. Does it prohibit angel funds to do co-investments?
Yeah, if the co-investment provision do not provide for it, then they would not be allowed to do it. We'll have to look at the regulatory framework on this once. I don't remember this offhand, whether angel funds are prohibited. I've personally not seen angel funds do co-investment schemes, but I'll have to check this one. Sorry, cannot say offhand. We'll have to look at the regulations for this one.
And Aman is asking whether we need to verify if existing investors are accredited or not.
Yes, Aman. So I think you would need to verify that for the annual activity report because SEBI has mentioned in that you have to give a list of investors who are accredited, how much funds have you raised from them, etc. So an exercise that, and we are facilitating this at Navigate AIF also, where we are helping people kind of verify which of the investors are accredited by way of an API or through a platform. So this is something that will come in. You can even reach out to the accreditation agencies to verify this with them. But yes, this will come in this year to look at how many of existing investors are accredited for the annual activity report that has to be filed. You can even ask them if the investors are telling you directly. That will also work.
The next question is by Monica. Please suggest methods to follow for compliance with respect to co-investment in Cat 3, though not allowed, but there are people in industry doing so. Guide how. Compliance, what can we do?
Yes, so I also don't think co-investment is permitted in Cat 3. The definition of co-investment only under the regulation specifies Cat 1 and 2 investments.
Maybe those guys are doing it through the PMS co-investment licensing.
I don't
Does that
think
allow Cat 3?
no. Co-investment definition only is Cat 1 and 2. So yeah, Monica, I don't think you can do co-investment in Cat 3. I don't know how people are doing it in the industry. I think it should be non-compliant.
The next question is by Priyanka. If a new company has started PMS and AIF business and the AUM is below 3,000 crores, then the entity will be categorized as a self-credited RE. Is this understanding correct? This is from the perspective of cyber security.
Yes, that is correct understanding.
Just one clarification there. I think 3,000 crore has to be taken on a consolidated basis. It's not at a fund or a scheme level. It is for all the schemes or all the funds currently floated or running by the same manager.
Very true. Yes.
The next question is by Manali. What are the exact timelines for cybersecurity for an AIF who comes under self-certification?
So timelines are an interesting question. So the SEBI had actually extended the timeline for compliance to 31st August 2025, and there's a separate requirement under the CSCRF circular which provided a timeline for initiating VAPT in the first quarter of the financial year. So ideally, a lot of funds, at least what I have seen, is that they have done the compliance for this year also, FY 2020, FY 25-26, which they are done by 31st August itself. And some of the newly launched funds that are received license this year are doing, we may do the compliance next year, but I don't want to give legal advice on the webinar. So let's keep any particular relevant question, like we can respond over email. That will be better.
So Sai has a question. Just a mere website displaying the statutory details like registration details of the AIF, be disability certificate compliant.
Yeah, so if it's the website of the AIF as a digital product, you would have to disclose it to SEBI as a digital product, and you would have to make it compliant for digital accessibility.
So just to add here, I think displaying the details such as the name of the manager, name of the scheme, registration number of the AIF, etc. on the website is a separate compliance in altogether. And having the digital disability compliance is a separate audit IIAP to be done by an IIAP certified auditor is a separate compliance altogether. Merely displaying your registration records on your website does not ensure that disability circular compliances.
Right.
So I think we're at time, so we'll take one more question, and more questions can be shared with me when I can forward it to the speakers. Just a last question, from Pradeep. I think asking investors about being AI won't be sufficient. For ease as a simplified process, we will still need to ask them to share the AI certificate, but from their CA this time, despite NSDL and paying a fee to get the same, right?
So, Pardeep, SEBI hasn't clarified the process on how do you get the accreditation details from, whether you get it from SEBI or you get it from the investors. All SEBI has said it in the annual activity report, you have to disclose this. If the investor is willingly telling you, that solves the whole issue. You can directly ask them if they're accredited or not, and disclose the relevant thing to SEBI. You don't have to always either approach the CA or an SDL. I would strongly advise that you read the revised annual activity report format, see what exact disclosures are given, and you can see if you have the relevant details, you can directly disclose it. My sense is that maybe people may not have all those details and may need to go back to investors to figure this out. Yes.
So while we have a few more questions, we are also at time. I can note down the questions and share with the speakers and get back to our participants after this. I want to thank everyone for joining us today. Thank you, Parth and Jugal, for taking out the time and sharing your expertise in an area that everyone is trying to navigate at this point. And thank you to the audience for being engaged throughout. If you found this session valuable, we would like to be a part of more such conversations. We'd be glad to have you engage with us at the Fintech Convergence Council more closely. We regularly organize knowledge sessions and undertake industry representations to shape policy outcomes for the ecosystem. As a member, you would have access to these discussions and the opportunity to contribute to them. I would be happy to connect and share more details. If you're interested, please do reach out to me on the email IDs that I've dropped in the chat box. And thank you so much again for joining, everyone. Thank you.
Thank you.
Thank you.